What's going on, everybody? And welcome back to another episode of the Trade for Yourself podcast, where my mission here is very simple. I just want to help you learn how to trade for yourself. So make sure you please like this, please subscribe. Make sure you listen to this episode from start to finish, okay? I promise you, you will not regret it. Please note that anything discussed in this episode is not financial advice. So please do your own research before investing into any stock. This episode is going to be talking about why inflation is not going to be that important to the stock market in 2023. Inflation was so bad, we had 40-year high inflation last year. But at the end of the day, we have already met peak inflation in the cycle, and inflation is continuing to come down. It may not be coming down as fast as what everybody wants it to or how everybody expects it to, but the market has came to grips with that. And I'm going to talk about in this episode why I personally believe that. So let's go ahead and get right into it. Okay, everybody, so let's start this episode off by looking at a tweet. And shout out to @LuisdoXBT on Twitter. I really appreciate him for giving us this information. Now, he gave us a tweet, and he tweeted the last year's S&P 500 performance on CPI days. Now, remember, last year we had sky-high inflation. One thing I want us to keep in mind is that last year we had 7 months that the stock market moved up or down greater than 1.65% when we got our CPI data, okay? We had 4 straight months, August, September, October, and November, when the stock market moved up or down more than 2.1% in a particular day. On a particular day, when we got our CPI data. Now, it makes sense why this was happening was because the stock market had the worst first half that it had since 1970 last year. That was due to sky-high inflation because we have been getting inflation readings that were the worst in 40 and 41 years. But notice what has been happening since November. In December, the S&P 500 only moved up 0.73%. In January of this year, the S&P 500 only moved up 0.08%. And today, the S&P 500 was only down 0.03%. So plus or minus, over the last 2 months, the S&P 500 has not moved up or down more than 0.1%. So we have to ask ourselves this question: why are the reactions to this CPI becoming less prominent? Okay. I believe there are 2 reasons. I believe that inflation is coming down, and we have already had peak inflation for this cycle. I talked about this last week on one of my episodes of the Trade for Yourself podcast. You have to understand that we have already met peak inflation. And the next article that we are going to look at is going to show that in a chart. The second reason is this: the risk of inflation is not big enough for investors not to put money to work, okay? Investors have capital and they have to put money to work, right? It's a risk to reward ratio when you're talking about investors putting money to work. If we already know that inflation has already reached its peak, but we understand that it's going to take time for inflation to come down, investors are now saying, hey, the risk is not to inflation anymore. We need to just spend our time focusing on the companies and understand that we need to put our money to work. Understand this: the market will eventually get tired of headlines. We have been talking about inflation for an entire year, right? Eventually, the inflation headline is going to drop off the wayside, and we're not going to talk about it as much anymore. Think about COVID-19. COVID was a major storyline. We went into a very, very deep recession because of COVID. But COVID was still around in 2020 and 2021, but the stock market went on about its business. The COVID headlines did not move it as much. And so it's kind of like the same thing now when we're talking about inflation. The stock market was only down 0.03% today when this news came out. Last month, the stock market was only up 0.08%. This is telling us that inflation is not going to mean as much in the future. It's not going to mean as much this year as it was last year. You also have to put this into perspective as well. The S&P 500 is not going to keep having 4% days and 5.5% days, like back to back to back to back. It's not going to keep doing that on this particular number. Eventually, the institutions are going to stop doing that over a period of time. And so just really truly look at how the stock market has reacted to the inflation number over the last 2 months. I believe that how the market has reacted over the last 2 months is an indication of how it will react as the months continue to go on. Now, this is the article that I was talking about from CNBC, and we're going to go through this article. And inflation rose by 0.5% in January, more than expected, and up 6.4% from a year ago. So inflation was up 0.5% month over month, and it was up 6.4% year over year. Now, inflation rose in January by 0.5%, following a 0.1% increase in December. The CPI was up 6.4% from the same period in 2022. Across the board, increases in shelter, food, and energy boosted the index after inflation had shown signs of receding in recent months. Supercore services inflation, which is key for the Fed and excludes food, energy, and shelter, rose 0.2% for the month and was 4% higher than a year ago. Now, inflation turned higher to start 2023 as rising shelter, gas, and fuel prices took their toll on consumers, right? The Consumer Price Index, which measures a broad basket of common goods and services, rose 0.5% in January, translated to an annual gain of 6.4%. Economists had been looking for 0.4% increases and 6.2% increases, respectively. Excluding the volatile food and energy, the core CPI increased 0.4% monthly and 5.6% from a year ago, against the respective estimates of 0.3% and 5.5%. So in a nutshell, we see that inflation was higher than what all the analysts had anticipated. But if we look at this chart, we can see that we have already met peak inflation. The dark blue line measures the CPI for all items. The dotted blue line measures the CPI index, taking out the food and the energy components because they are volatile. As we can see, we have met peak inflation in terms of all items. We were at 9% in June of 2022. Now we're at 6.4%. Less food and energy, we were 6.5% in March of last year, and we had 6.6% in September. But now we're at 5.6%. We're below where we were in March, February, and January of last year. So we see that inflation is going to come down. It's going to take time for inflation to come down, but nevertheless, inflation is coming down. Now, the markets were very volatile following the release, with the Dow Jones down about 200 points at the open and heading lower. But we saw that the S&P 500 was only down 0.03%. Rising shelter costs accounted for about half the monthly increase. The component accounts for more than 1/3 of the index and rose 0.7% on the month and was up 7.9% from a year ago. Again, CPI had risen 0.1% in December. Energy was also a significant contributor, up 2% and 8.7% respectively, while food costs rose 0.5% and 10.1% respectively. Now, the rising prices also meant a loss in real pay for workers, with average hourly earnings falling 0.2% for the month and were down 1.8% from a year ago. Now, while price increases had been abating in recent months, January data shows inflation is still a force in a U.S. economy in danger of slipping into a recession this year. That has come despite Federal Reserve efforts to quell the problem. The central bank has hiked its benchmark interest rate 8 times since March 2022 as inflation rose to its highest level in 41 years last summer. Inflation is easing, but the path to lower inflation will not likely be smooth, said Jeffrey Roach, chief economist at LPL Financial. The Fed will not make decisions based on just one report, but clearly the risks are rising that inflation will not cool fast enough for the Fed's liking. In recent days, Fed Chairman Jerome Powell has talked about disinflationary forces at play, but January's numbers show the central bank probably still has work to do. There are some good news in this report, though. Medical care services fell 0.7%, airline fares were down 2.1%, and used vehicle prices dropped 1.9%. Egg prices, however, rose 8.5% and are up a stunning 70.1% year over year. Now, evaluating supercore inflation. The rise in housing prices is keeping a floor under inflation, though those numbers are widely expected to decelerate later in the year. That's why some Fed officials, including Powell, say they are looking more closely at core services inflation minus shelter prices, supercore, in determining the course of policy. That number rose 0.2% in January and was up 4% from a year ago. Markets expect the Fed over its next 2 meetings in March and May to raise its overnight borrowing rate another 0.5 percentage point from its current target range of 4.5 to 4.75%. That will give policymakers time to watch for the broader economic impacts of the monetary policy tightening before deciding how to proceed. Should inflation not fall back, that could mean more rate hikes. Dallas Fed President Lori Logan on Tuesday cautioned that the central bank may need to push rates higher than expected, particularly if supercore remains anchored in the 4 to 5% range. We must remain prepared to continue rate increases for a longer period than previously anticipated, if such a path is necessary to respond to changes in the economic outlook or to offset any undesired easing in conditions, she said during a speech in Prairie View, Texas. Logan is important because Logan is a voting member this year on the rate-setting Federal Open Market Committee, adding that she is concerned about higher commodity inflation as China reopens from its COVID lockdowns and sees a surprisingly strong labor market as another risk. When inflation repeatedly comes in higher than the forecast, as it did last year, or when the jobs report comes in with hundreds of thousands more jobs than anyone expected, as happened a couple of weeks ago, it is hard to have confidence in any outlook, she said. Now, they also talked about the recession possibility. Now, the big data point will be retail sales, which hits Wednesday morning at 8:30 a.m. Economists surveyed by Dow Jones expect the figure, which is not adjusted for inflation, will show that sales rose 1.9% in January from the prior month. The strength of core inflation suggests that the Fed has a lot more work to do to bring inflation back to 2%, said Maria Vaslow, co-chief investment officer of multi-asset solutions at Goldman Sachs Asset Management. If retail sales also show strength tomorrow, the Fed may have to increase their funds rate to 5.5% in order to tame inflation. There's widespread belief that the economy could tip into at least a shallow recession later this year or early in 2023. However, the latest data tracking from the Atlanta Fed puts expected GDP growth at 2.2% for the first quarter, following a relatively strong finish for 2022. A New York Fed barometer, which uses the spread between the 3-month and 10-year Treasury yields to estimate the probability of a recession, puts the chances at 57% over the next 12 months, the highest level since the early 1980s. January's CPI report will take some time to analyze, as the BLS changed its methodology and how it reports the index. Some components such as shelter were giving higher weightings, while others such as food and energy now have slightly less influence. The Fed also changed how it computes an important component called owner's equivalent rent, a measure of how much property owners could get if they rented. The BLS is now placing a bit more emphasis on the pricing of standalone rentals rather than apartments. Now, what I really want to do is just put this entire article into perspective here, okay? We understand that inflation is higher than what analysts had anticipated. But at the same time, inflation is still going down. It's just that people are going to have to be patient and allow inflation to actually come down, because I'm telling you, it is going to eventually come down. Jerome Powell, the chairman, actually admitted that inflation is starting to come down. He just understands that it's going to take time. This particular report, like they said in the article, is not going to make or break the stock market. Any one CPI report is not going to make or break the stock market this year, because the market is already anticipating this. The market is working and pricing all of this stuff in, okay? The Fed also let us know that they're only going to be raising interest rates in 25 basis point increments. That's much better than 50 and way better than 75. This again lets us know that the Fed is actually looking at things. They're actually paying attention. They understand that the shelter component is very, very sticky, and they understand that the food and energy are very, very volatile. So what they're doing is that they are being data dependent. They are looking at overall inflation and seeing what is actually happening. That's actually a good thing for the stock market, because the Fed is not just looking at this 6.4% number and just taking and just saying, hey, we're going to raise by 50 basis points. They're being measured. They're being calculated. They understand that they've already raised interest rates by 450 basis points in a year. They already understand that. And so what they're going to do now is they're going to be very measured. And like I said, as we continue to move forward, what we see from month to month from CPI is just not going to be that important to the stock market. So to sum this up, everybody, inflation is just not going to mean that much to the stock market this year. In January and February, the stock market did not move up or down more than 0.1%. Not 1%. We're talking about less than 0.1% in 2 consecutive months. That's telling us that investors are not too keen on it right now. They're not paying attention to it. Okay, inflation has already peaked. We have already met the peak in the cycle. It's coming down, but it's going to take time to come down. Even the Federal Reserve, by what it is doing by only raising interest rates by 25 basis points, is acknowledging, okay, that inflation is going to continue to come down. Understand this, investors have to put money to work, and I believe that the risk for inflation is not a big enough risk that will cause them not to put money to work. So I believe that we should be building our portfolios, putting money into the market every single month, because now is the time for you to be building your portfolio and making smart investments. As always, I appreciate you all for tapping into another episode of the Trade for Yourself podcast. Please like this. Please subscribe. Make sure that you hit that notification bell so you can be in the know every single time I drop an episode. And please watch my episodes all the way from start to finish. I promise you, you will not regret it. As always, remember, don't pay for it. Trade for it. I'm going to see you all on the next episode.